Hi everyone, Bowen from Enhanced Asset Management here. Just back to provide a quick update as we head into 30 June. Just want to talk about the market at the moment and how we're positioning and the stocks we're invested in and how that's going at the moment. So we'll start off with the oil price, and this has been a bit of a key theme that we've been following over the last sort of 3 or 4 months as the war in the Middle East has progressed, and we're now at a point where there's a ceasefire in place. It's a pretty fragile ceasefire. We've seen the US and Iran trading shots over the weekend, but basically that has been a bit of a trend at the moment. The ceasefire has been holding pretty well during the week, and then when the market's closed, we'll see tensions pick up a little bit, and then by Monday morning, it seems that the ceasefire is back in place and everything's okay. So, I mean, the market started to look through all the issues that's going on in the Middle East, and by all reports, oil is flowing relatively well through the Strait of Hormuz, and we're seeing that reflected in the oil price, which is now back basically where it was at the start of the war in March, and the effect that has is lower inflation in Australia, particularly given the fact that we import so much of our oil, and the impact that has had, lower inflation. It's lower bond yields, and we've spoken about in previous updates and in a lot of our quarterly reports over the past 6 months that these higher bond yields that we've seen have been impacting the valuation on growth businesses and also impacting investor sentiment towards these growth businesses. So, we had bond yields down at low 4% back in October, and they peaked at 5.1, 5.2 in March. So that had a big impact on growth businesses and the way that the market was treating them. But we're now in a position where we can see on screen here the bond yields have come down to around 4.7, and that's largely been a function of the oil price coming down. So this creates a pretty good backdrop for growth businesses. And I speak about it here in these slides. Times like these have been quite rare in the past few years. And what I mean by that is we're now in a position where we have a combination of tailwinds towards these quality growth businesses. You've got strong earnings growth, which has been a feature throughout the past few years and continues at the moment. We've got falling long-term yields. In retrospect, over the past 6 months, they've been rising, which has been a negative headwind towards these growth businesses. But now that's going the other way, and that becomes a tailwind for these really strong growers. The other thing is we've got really attractive valuation multiples, which we haven't really seen for a long time for some of these really high growth businesses. And what those three things in conjunction create is a really positive backdrop for quality growth businesses in Australia. There's obviously still a few slight headwinds that do remain. There's the AI disruption threat that still hangs over a lot of our technology sector, and that's part of the market that we operate in a fair bit. We continue to believe that these threats are overblown and that they will actually be a tailwind for a lot of the technology businesses that we are invested in. Also in the US, the AI infrastructure and memory chip sectors continue to attract significant investor flows. We saw the SpaceX IPO and the way that stock's performed post that listing. And that's kind of driven a bit of a rotation away from a lot of the software companies into these AI infrastructure and memory chip and that sort of exposed business. It's created a bit of a near-term headwind for our technology sector, given that we're basically 100% software in Australia. We don't have a whole lot of the exposure to the AI thematic. But as we've said previously, the earnings growth continues. It's more just a sentiment thing that's driving a little bit of a disconnect between the fundamentals and the share price for a lot of the software companies here. Positively, we've seen a lot of portfolio companies perform really well over the past 3 months. So I've just got 3 stocks up on screen here. So you've got Zipco, which is up almost 100% over the past 3 months. And that's been a combination of really strong fundamentals and a bit of a turn in investor sentiment. Medicus as well, it's up about 70% over the past 3 months. Again, that business just keeps on keeping on, and it got down to a valuation multiple that was extremely attractive, and we're pretty happy with our position in that one. AUB is up around 20% over the past 3 months. That's benefited from a takeover bid for one of their peers, Steadfast, at a pretty attractive multiple. So we expect that there'll continue to be a little bit more re-rating in AUB. The pleasing thing is that there's still plenty of upside to come. So some of the portfolio companies I've got up on screen here, it's a bit of a congested chart. But you can see Car Group is only up 13% for the last 3 months. ABB, Aussie Broadband's up 7. Xero is pretty flat. Netwealth is pretty flat. And REA and GDG are still down for the last 3 months. So plenty of upside to come. We expect all these businesses to report really well in August. I mean, apart from Xero, who report in May and November. But these businesses are continuing to perform really, really well, and the backdrop now for these high growth businesses looks really supportive. So, in summary, the market conditions are now starting to look pretty favourable towards our investment universe. We've had a lot of the portfolio that is still yet to re-rate, which is exciting and provides a good runway for growth here. Given the ASX is weighting towards banks and large resources, we expect that there's a lot of opportunity here to add value to the portfolio using our direct positions, which is a bit of a key feature of the portfolio. We aim to add value over the market with our direct stocks, and the positions that we've got in the portfolio right now have very little exposure to the things that the banks and the resources do. So they probably shouldn't move all that similarly to the index, which we think is a good thing over the next 6, 12, 18 months, because rates come down, earnings grow up, and we expect these positions to continue to do really well. As always, this is general information only. If you do require any further financial advice, please reach out to your advisor. If you have any questions on the market, feel free to send us an email or give us a call. We're always happy to take questions from our client base.